Generating traffic and sales can be a challenge for online merchants. But selling on the Walmart Marketplace puts your products in front of millions of customers who shop on Walmart.com. And right now, sellers who join Walmart Marketplace can save up to 50% on referral and fulfillment fees for the first 90 days. So get started today. Head over to marketplace.walmart.com/savings. That's marketplace.walmart.com/savings.
Welcome to E-Commerce Conversations, a weekly podcast focusing on e-commerce topics featuring interviews with prominent people in the e-commerce space.
This is E-Commerce Conversations by Practical E-Commerce. I'm Kerry Murdoch. The lack of capital can prevent an e-commerce business from growing, but many merchants are unsure as to how to obtain capital or how the funding process works. Our guest today has raised many rounds of funding over his career, most recently with RatePoint, the reputation management firm. He's Neil Creighton, co-founder and CEO of RatePoint, and he joins us to explain the funding and venture capital process. Well, Neil, thank you for your time today.
Thank you, Kerry, for having me back on the show.
Neil, RatePoint, your company, RatePoint, you offer products that I know will interest our audience of e-commerce merchants, but our topic today involves the recent announcement that RatePoint has raised $7 million in funding, and we're going to ask you to wear a different hat for us today, and that's a hat of financier, if you would, and talk to us briefly about that funding, how it works, and the purpose would be for merchants that are interested in the funding process or interested in perhaps raising money themselves, kind of the thought process that's involved in doing that. Is that acceptable with you?
Yeah, that's great. I mean, there's obviously a lot to that, and I'd love to give you my thoughts on the fundraising process.
That's great. I know on the recent announcement, congratulations, by the way, RatePoint has just raised $7 million. I believe the announcement said Series C round led by 3 separate venture capital companies. My first question is, what do you mean by Series C?
Yeah, there's a lot to the fundraising process, and it really happens in different stages. So rarely does a company raise money at one time. And when people refer to series, they're talking about how many rounds of financing you've had. So if it's Series C, it means you've had 3 large rounds of financing, starting with the A, followed by the D, and then with the C. And in that case, generally, you probably have the same investors through those large rounds of financing. But if you look at RatePoint in total, we've raised $23.5 million through 3 rounds. But it also includes a early seed round where a lot of people start in financing, and that is a very small round to get the company going, to prove out its milestones. But if you add all the financing together from the day we started the company until now, it's $23.5 million that we've raised.
Congratulations. That's a real accomplishment. Why the 3 companies? How did you pick the 3 companies that are mentioned in the announcement recently? There are 3 companies that were the principal investors. Why those 3?
Yeah, as a entrepreneur, there's a lot of different routes potentially to financing. One is debt, one is equity through investors. And you really look for people, when you're looking for partners, you want to look for people that you think have knowledge of the space that you're in. So if you're an e-commerce merchant, you want a strong investor with e-commerce experience. And then you also want investors that have what I call deep pockets. So as you go through rounds of investment, so they'll be there to support the company. And these particular investors that are in RatePoint, I actually started working with about 9 years ago. This is my 3rd startup company. And in my first one, I was fortunate enough to go around and meet different people, and I had 3 investors in those companies as well, and I was able to work with the same 3 throughout the history of all my companies. So I've known them a long time. I've worked with them. I know how their firms operate, but I did have to go through the initial introductions 9 years ago to meet them and find them as a match. But because of their experience and their relationship with me and the team here, we're happy to invest with them on this round of financing.
Now, when you go about raising that money, Neil, does that come in to your firm? How does that come in? Is that debt? Is that equity? Is it a combination?
Yes. So, I mean, again, there's other routes to get financing. I mean, a typical company is originally financed by its founders, and the founders will put in money in the company in the form of equity. And if the company is doing well and generating cash flow, and you have some options. One is you can do a debt financing where you borrow money, and we've done that in the past year as well, and over time you pay it back. And the benefit of that is you don't give up equity in the company or ownership to somebody, but it's often hard to get debt financing, especially during a recession. The other way to do it, and that's the way we've done this round, is we actually sell equity in the company to investors. They buy it, they put the cash in it. We use that cash to operate the company and grow the company. But in turn, the investors get ownership. And when the company has an exit event, and that exit event could be an IPO, which we hope we have at Raypoint, or it could be a sale of the company to a larger company, the investors get paid back from that exit event. So they're in it with you for the long term. I mean, they want the company to be valuable. There's no debt. They're not going to be paid back unless the company does well. So they're putting their faith in you, and you're putting your faith in them, and they're doing it in the form of equity.
I suspect we have listeners, Neil, that our listeners, e-commerce merchants, that may be saying something along the lines of, if I just had more capital, I could really grow this business. Perhaps our listeners feel like they have a unique product. Maybe they've invented a product. They just need money. What's your advice to them if they're in that situation that they've got something that they believe is really unique, but they don't have enough money to grow their business?
I think for anyone starting a business, if you have an idea that's unique, and if you can find some initial capital to prove out your concept, whether you're providing it yourself or whether you go to friends and family, or perhaps an angel investor, which could be a wealthy individual that you get connected with, and get a little bit of financing to prove out your point. I mean, what you want to show is that the business works, that people are buying the product, the economic model works, and you can do it in a very small way. But if you can show some initial prototype or some way that the company is working out, you can attract a larger investor. And what I mean by that, a larger investor is a venture capital fund. And there are lots of venture capital funds in the United States, and they're in the business of looking for the next big thing, and they invest in a lot of companies with a lot of ideas, and they turn a lot of companies down that come in. They it's tough to get in there, but if you can get in there and show some traction, show that your model works, and you put some investment in it on your own or with other people, you could be able to attract these larger investors to put capital into your company. But I do think the key for anyone starting out today is not coming out with a business plan and going directly to an investor, but it's coming out with a business plan and building something as far as you can, support it, to show that it works, and at that point, trying to bring that concept that you've somehow proven out a little bit works to an investor who might take a look at it, see what you've done, and see the commitment you have to the business and its possibilities, and invest in it with you.
What's the trade-off for a company that's raising equity? There's certainly a trade-off there. So what are the pros and cons of going through that process?
If you really want to raise venture capital money in particular, you've got to decide up front that you want to have a large company. If you want to have a company that gives you a certain lifestyle and gives you a good level of income, and you want to have a high level of control over that, and you can make that work within your own means or with family investment or friends and family investment, you should probably not go outside. But if you're trying to make a company that's worth $100 million, $200, $1 billion, if that's your vision and that's what you want to do, venture capital would be the way to go, because it's hard to get there on your own. But you have to realize when you do it, you basically lose control. That's not necessarily a bad thing, but you have to sell a large percentage of the company to get the investment inside, because every venture capitalist that invests wants to get a certain return, and that return is generally anywhere from 4 to 6 times the money they put in your company. So if they invest $20 million, they're looking for a return that's 4 or 5 times that. So it's a rather large company. So they're going to need a large ownership stake in your company. What you get in return is you get the capital, though, to build your business, and you as time goes on, you may lose control where you're no longer able to run the business if things aren't going well. They may bring somebody else in to take your job because they have control. But if things go well, and generally they're in it with you, you have the opportunity to create a very large company and get a very, very large return on that. And the venture capitalists bring to bear not only the capital, but they bring in the contacts. They'll bring in partnerships potentially. They'll introduce you to other investors. So in the end, the whole concept that a small piece of a larger pie is better than a big piece of a very small pie. And if you believe in that, then venture capital is appropriate for you. But if you are worried about that, you're worried about control, or you're not trying to build an extremely large company, you're trying to build one that provides you a certain lifestyle that through income and a schedule that you like, then venture capital may not be for you. So you have to think about those things. So there's obviously trade-offs, but with money you get the ability to do things a lot more quickly and move a lot faster than you would if you were trying to finance it on your own.
What's the current market like for raising venture capital money, especially as it relates to e-commerce businesses? Are you familiar with that?
Yes, I mean, I've raised a lot of venture capital money in my career. I think in total it's been near $50 million or so that, or maybe more that I've raised. I kind of lose count, but it's a lot. And what I've found is that there are cycles, and sometimes the cycles are good where they're looking, venture capitalists are looking at ideas and they're investing more heavily. During recessions, it's very, very tough. So they're looking a lot more carefully at the business models and how they operate, and they're not financing as many deals. So what I advise entrepreneurs to do is when they see a venture capitalist, they really need to understand their economics and their financial model about how their business is going to scale and how they acquire customers. And if they have a working model for that, they're gonna do a lot better than someone coming in with a business plan that's not well thought out. So it is a very tough time, but what I've found is if you have a very good idea and you have really good people in your company, especially people that have been successful in the past, you understand your economic model and you have domain expertise in a certain area that's very, very strong, you can get venture capitalists to listen to you. And if you talk to enough of them, if you knock on enough doors, you'll find somebody as committed to your dream as you are if you work hard enough. So it's a tough time, but it can be done if you're very committed and you have a good idea.
Okay. Well, let's change gears just for a sec, Neil, and talk about your current company, RatePoint. It's attracted $23 million, which speaks for itself. Tell our audience what RatePoint does, our audience of e-commerce merchants, the products it provides, and how it could appeal to them.
Right. I mean, so, RatePoint is trying to provide the most powerful word-of-mouth marketing tool a small business can have. And we know that 70% of consumers today look for reviews online before they decide to pick a business, whether it's a contractor or whether it's a product they want to buy or whether it's a merchant they want to buy from. They're actively looking for reviews, and these reviews are being fed to them or they're reading them on Google or Yahoo or Bing or Yelp or other places. And what RatePoint has is a platform that integrates into any e-commerce site or any business's website and allows them to collect reviews from their customers and syndicate those reviews back out. So in the case of a positive review, it will come in, we will push it back out to Google, Yahoo, and Bing. So if people are looking for your services, they can see what your customers are saying about you. And in the case of a negative review, we have the ability to do a dispute resolution and try and resolve that issue with the customer before it gets published. And today, everyone's talking about businesses. You're going to get bad reviews, but at least with RatePoint, you have the opportunity to resolve them, and about 90% of them get resolved. So it's a very, very powerful retention tool. So it's all about collecting reviews, syndicating reviews back out, and on top of that, we've bolted on email marketing and surveys for small businesses, which is also a very powerful tool to acquire new customers and to get more out of your current customers. So it's all about your business reputation, what people think about you, and your relationships to your customers at a very, very affordable price. And today we have tens of thousands of businesses using our services. We're growing rapidly, and we're helping a lot of small businesses grow.
You mentioned affordable prices there, Neil. What would a merchant expect to pay for a range of prices that a merchant would expect to pay for your services?
Our typical merchant pays about $40 a month, and with that they get all the review platform. they get the email marketing and surveys included. And they could end up paying more based on how many reviews they want to publish out or how big their email contact list is. But in general, a typical merchant pays us about $40 a month for our services, so pretty cheap. And they have a very strong ROI, and they're able to track that ROI back to show what it's doing for their business.
All right. Well, we have just another minute or so left here. Anything else on your mind today for our listeners as it applies to fundraising or to RatePoint?
On the fundraising side, I would just say, I've always believed that if you're extraordinarily passionate about what you do and you stick in there and you've got a good idea, there are a variety of different ways to fund your business. And a big part about being successful is surviving. And if you work hard enough, my first venture, I basically went into 50 venture funds, and I was politely asked to leave within 49 of those. But I found one that would invest in my company, and we ended up doing a $10 million round. And that company was called GeoTrust, which was 3 people in a garage, and then within 6 years, we did sell it for $125 million to VeriSign. But I have to say, it was a tough road. I mean, we had a very successful business, but if we weren't persistent, if we didn't keep after it, and if we didn't knock on 50 venture capitalist doors, we would never have made it. And so a lot of it is just being really persistent about your dream. And if you can do that, and you have a good idea, and you don't give up, you have a chance of making a really big company.
Okay. Well, for purposes of our listeners, we've been visiting with Neil Creighton. Neil is the co-founder and CEO of RatePoint. He's an e-commerce pioneer and innovator, the serial entrepreneur. RatePoint provides reputation management services and other services for smaller e-commerce businesses. That site is ratepoint.com. And Neil Creighton, the co-founder and CEO, we want to thank you for your time today, sir.
Thank you, Kerry.
Thank you so much.
That's all the time we have for this week's e-commerce conversation. I hope you enjoyed it. Please tune in next week for another new episode.